A special guest, Viktor Shvets. You don't see him often on TV, but today I have the pleasure of inviting him on ET Now. Viktor Shvets, Managing Director at Macquarie Securities, joins us now. Viktor, good morning. Thank you for joining us. What is your worldview right now? Mainly, the US is where all the action is. The Trump administration has proposed a very brave and I would say ambitious plan to bring American corporate tax rates to an historical low.
Soft numbers and hard numbers that ever been the case. So in other words, since election of Donald Trump, the confidence has increased, but the hard numbers has not come through. In terms of taxation, taxes have not been slashed at all. What you have seen in the headlines is a president's wish, not his command. I personally think that the tax package that was proposed yesterday have almost zero probability of occurring. Therefore, I don't think it will add much at this stage in terms of growth rates of the US.
Right. Viktor, hi morning. Various agencies like IMF, World Bank are hiking global growth estimates. What do you make of that? And are you in sync with that view?
Of course, it's a contrarian indicator. Whenever you have IMF or World Bank increasing numbers, that's when you should be worrying about the growth rates that is going to come through. But it is true, what we have seen over the last 12 months is quite a strong reflationary wave driven primarily and almost exclusively by China. China embarked on the second largest stimulus they have ever done in February-March 2016. Therefore, what you're seeing in IMF numbers is just numbers are catching up with reality. Far more interesting question to ask whether in fact that reflationary wave already crested. And in fact, we are increasingly losing that reflationary momentum, which is only later will be reflected in IMF or World Bank numbers.
Now, China is, for the moment, Viktor, they've managed to change their so-called business model or the economic model. Do you think the deflation trade, which has got triggered because of China, is that here to stay? And do you think China is now more like an inward-looking economy rather than export-dominated economy?
The answer is no. There is almost no rebalancing that is occurring in China. At the current pace, it will take China more than 2 decades to rebalance. So that's not realistic. But what we are seeing is that China being a guardian angel of a global economy. China is the only country in the world that is capable of reflating global economy. And the reason for that is very simple. Whenever China decides to reflate, they do it large, fast, and it's a brand new money. Whenever the West or India, for example, tries to reflate, it's usually small, it's spread out through time, and it's usually borrowed money. If you're borrowing money, you are crowding out other investment opportunities. That's why China is so successful. China is also so successful reflating global economy that they're using their savings to invest. China has 47% saving rates, of which 45% is spent on investment. Almost all of it goes into either real estate or infrastructure, which in turn is highly commodity driven. So if you were to ask me what caused the reflation, it was China's decision in February and March to embark on a very significant stimulus, mostly directed towards real estate, which has a high correlation with the commodity indexes. Because China does not have independent central bank, because China does not have independent banking system, because in China monetary and fiscal policy are fully coordinated, and because China has a very limited private sector, whenever injection of liquidities are done, they transit very quickly through the economy into the areas that China wants to stimulate. And usually China just have 2 levers, one called real estate, the other one is infrastructure, and they usually rely on one or the other to accelerate the economy. But by accelerating the economy, they're reflating the world.
Okay. For the Indian economy then, Viktor, what's the road ahead post-demonetization? Because it's getting back to normalcy gradually.
Well, India is one of the very few countries in the world where there is still productivity. I usually look at the world as a place where there is no longer any productivity at all. But there are a couple of little places, it's like little lakes still left, where there are opportunity for productivity growth rates. One of those little lakes is India. China, for example, has almost negative productivity growth rates right now. So one of the things that is helping India, India still has productivity gains. The other thing that helps India going forward is that India has not really participated in the prior waves of globalization. So one of the things that is occurring globally is that countries get disintermediated through technology. So one of the erroneous things, in my view, India tries to do is the slogan of Make in India campaign. We don't need any more factories as we go forward. We need other ways of growing economy. So India has a couple of positives. Number one, it has a productivity. Number two, it has a very stable monetary policies. And number three, it is an economy that likes equilibrium in terms of currencies and commodities. And so far, between Federal Reserve in the US as well as China, we globally still in that equilibrium spot. So India remains overweight market. It had been for the last 6 months and still remains today.
Now, Indian markets have seen a run up. How would you map the risk-reward ratio currently?
I don't pay as much attention to earnings estimates. In India, earnings estimates almost invariably are too high. And almost invariably are cut only to be replaced by high estimates looking forward. The same pretty much happens with the multiples on which India and Indian equities are trading. To me, domestic liquidity and external forces that we described are far more important factors driving India. If we have a very strong reflation, India very quickly could become a stagflationary country. In other words, inflation rates in India tend to accelerate faster than real GDP. If we have a collapse, a disinflationary collapse suddenly emerging, India will be significantly dislocated through the currency market, through external vulnerabilities. But if we stay in a Goldilocks, as I said, India's inflation rates will be anchored. Productivity rates are still reasonably high and will continue to be so, which will underpin the GDP growth rates that you have. And I think most investors like that picture and would like to invest into a country like that. Now, there is also a structural reform agenda to India. I've never been a great bull on India's structural reforms. For very simple reasons. Structural reforms are hard. They're really hard. And therefore expecting that any country that is not suffering right now will be able to embark on a deep structural reform is just far too optimistic. But if I look at emerging market universe as a whole, it is not a group of countries that are actually reforming much, but there are one or two glimpses. And India happens to be one of those glimpses.
So, Victor, how would you rate Modi's leadership and the reform measures being taken by him?
The question is always one which is relative. Whenever India improves, the question is whether other countries improve double rate. So, in other words, you thought you were -2, but now you're -3, even though you feel you're better. That was a problem with India for a very, very long period of time, that whatever improvements were made were insufficient to counteract what other countries were doing at exactly the same time. I think this time around, India is actually moving faster. And what's helping India, in my view, is technology. Because in order to change political or bureaucratic system in India requires a monumental effort. So my feeling is that the government is trying to bypass bureaucracy, bypass politics by utilizing means that were not available 10, 20, 30 years ago. So I'm actually counting far more on a technology driving India rather than on a government being successful, making either public sector or any other sector in India much more competitive.
So what is your outlook at Macquarie for India going forward?
I think the question was asked at a stage, how does a governor reconcile new GDP numbers with the old GDP numbers? And I think his answer was something like, I don't know. And I do think that whenever you change how you account for growth, you do have discrepancies. And at least India is now trying to deploy a far more modern ways of determining GDP rather than production, rather than how many shoes you have produced or how many cars you have produced. So I think this modern methods capturing much wider part of the economy. I think they're much more survey-based, which is quite appropriate to do so. But when you run a new system, it takes time to become more efficient. So over time, I think the hard numbers and soft numbers, that is surveys and all the expectations, will converge much better to the GDP numbers that India is declaring. But coming back to the fact that because India's productivity rates actually increased in the last 5 years, so has Philippines, for example, it actually underpins a faster growth rates in GDP than traditionally India would have achieved. Whether we agree that India really growing at 7% or 5% is immaterial. What is material is that you're growing faster than you used to, and you're growing faster than most other emerging markets are capable.
Victor, when large clients ask you about India, what is it that you're telling them right now?
Well, first of all, clients would love to be in India. So if you think of emerging markets, the reason they like to be in India is that there is a framework in India. We can just debate whether it's chaotic. We can debate whether the whole process is chaotic. But there is a framework in India. There is a private enterprise in India. Whatever the best in the world is in India, whatever the worst in the world is also in India. So you can actually choose the best of the best and the worst of the worst when you choose whatever you want to invest in. Unlike some of the other emerging markets where the state is completely dominant, where private sector is not really private sector, in India, you actually have a great deal of variety. So the clients are predisposed towards India. They would like to buy India if they could. Sometimes valuations deter them, sometimes earnings deter them, but essentially they want to be bullish. From my perspective, I am in a similar camp, and what I'm trying to tell the clients is that India has many challenges, but it's also one of the very few places where not a great deal of effort can yield substantial returns. Very few countries in the world these days are in that position. Now, India, again, will not be in that position forever, but it just so happened to be right now they are, or you are.
Okay, Victor, appreciate your time. Thank you for joining us.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.